So in this video, we'll understand how do we select stocks, how do we do a screening of stocks, and this is achieved through carrying out a fundamental analysis. So we'll understand this in detail in this video. Now let's understand what are the various strategies or approaches to carry out fundamental analysis. Here we'll understand how do we carry out fundamental analysis of a company. Now the fundamental analysis is based on the premise that in the long run, true or fair value of an equity share is equal to its intrinsic value. Now, how do we calculate the intrinsic value of a share? The intrinsic value of a share is the present value of all the expected future earnings from that company. Now we know that the companies have indefinite life and the earnings are measured in form of dividends, capital gains, etc. Now, from the company point of view, it is a cash flow which the company generates during its lifetime, and we try to calculate the present value of those cash flows to arrive at the value of the company and then the value of the share itself. Now, the cash flow which are generated by the company are used to pay dividends, and some of the money gets plowed back into the business. And if the company grows, then the share prices also go up, and actually the shareholders get capital gains. Now, there are two approaches to do fundamental analysis. The first being the top-down approach, the second one being the bottom-up approach. And we'll understand both the approaches as we go along. So now we'll understand the top-down fundamental analysis. Now, there are three steps involved in this kind of approach. First, you actually look at the economic analysis or the macroeconomic analysis and understand how the economic situation will pan out. So evaluate the current economic environment and its effects on the industry and the company's fundamental. So how your economic situation will behave and what impact it will do to the industry and the company in which you're going to invest. So if the economic situation is going to improve or it is going to boom, it may affect positively to the industry in which you're going to invest, and it may have a great impact on the company and its potential profits in future. So first you have to understand about the economic situation. If the economic situation is gloomy and doesn't offer much, then you will stay away from investing in stocks or in certain companies. So then we come to the industry analysis. So after you have done your macroeconomic analysis, you move on and choose an industry in which you are going to put your money. So you may be bullish on banking industry, or you may be bullish in financial stocks. You may be bullish maybe in telecom stocks, or maybe whatever, in FMCG companies. So you're going to actually do a complete analysis of the industry in which you are interested to put your money. So what is the future outlook of the industry? Is there enough demand for the products which the industry or as a whole has manufacturing or are selling? And for example, the telecom industry, which started say in 1995. So there's a great growth potential during 1995 till say 2003, 2005, because you see, when they started, there was nobody owned telephones or mobile phones in India. And today, as we speak, there are about 80 to 90 crore mobile phones in India. So the telecom industry has grown like anything in over the last 20-25 years. So you look at the potential of the industry and find out what are the growth prospects of the industry. Is the industry is profitable? Is the industry having complete freedom to sell their products or manufacture? Because sometimes the government may have some kind of a regulatory framework which may actually negatively affect the company in which you are, or negatively impact the industry in which you are going to invest your money. So then you can stray away from those industries where the government has a lot of intervention and they put a lot of rules and regulations for the players in the industry to do business. Then after you have chosen the industry, you come to the company analysis. So you pick up the company which is the leader of the pack generally, and which has a good management and which have good efficient systems, and they have a great strategy to accomplish their goals. So you choose the company which has a lot of strength in terms of a core competency, or in terms of good management skills or good human resources. So you are going to choose that company which is going to have a great future outlook so that it can actually offer you a great return in future. Now let us understand the economic or the macroeconomic analysis. Now here we look at first the growth statistics of the economy and understand how would be the growth trajectory in future. If the growth is going to improve or sustain or do well in future, then we can think about investing in. Then the second thing is the interest rate. How they are going to behave in future? Are they going to go up or going down? Now if rates go up, then the cost of capital goes up, and it is the cost of doing business becomes costlier, and new investments don't come into the industry. Now if the interest rates come down, that will be good for the economy, and the cost of doing business will improve, and new investments will come into the industry, and the economy is going to do well in future. So the interest rates movements are very important to determine whether the economy is going to do well or not. And if the interest rates come down, it is good for many industries like automobiles, housing industries, and so many other industries, because if the interest rate come down, people borrow. It increases the credit offtake in the banking industry, and it is good for them also, as well as for the people who are looking for the products of the companies like housing companies or the automobiles or the white goods industry. Then the inflation. Now inflation, we know a higher inflation actually checks the competitiveness of the industry, and it leads to higher prices and pushes down the demand of many products. So higher inflation is not a scenario where one should put his money for investment. A higher inflation is not good for investing, and it also increases the interest rates in the economy and ultimately not good for the business. Then we talk about the currency. Now currencies may depreciate or appreciate against other currencies. So if in a situation where the currency depreciate, it may be good for the export sector, but it may not be good for the imports, because the imports will become costlier and it can hurt the profitability of the companies. Whereas if the currency appreciates, then it is good for the overall economy, and the imports will become cheaper, and it will actually improve the macroeconomic situation of the economy. Then we talk about the demographic, which is also a very important characteristics. We know that Indian demographics are very good. We have a very young population who would actually work in businesses and industries. Then the political stability is very, very important. If we have a stable government in power, it can pursue its policies and bring reforms in the country, so which may affect positively the business cycle. So political stability is one of the very important criteria of putting your money into the equity markets. So generally, after we have done the economic analysis, then we move on to do industry analysis. So here we look at so many factors. The first one being the demand and supply gap. So what kind of a demand the industry enjoys for the product and services they are providing to the customers. Are there enough players in the industry? How's the supply situation? Are there idle capacities in the industry? So all these will have an impact on the future of the industry. Then when you look at the competition, how many players are there in the industry and how they are competing? Is the competition healthy? Sometimes a good competition can lead to expansion of the market, and it may be good for the individual companies within the industry. Then the product life cycle. If the product is nearing to its maturity or going to be taken over by a new product, or the product is getting obsolete, so we'll not like to put our money into such kind of industry. Then we talk about barriers to entry. Can the new players enter into the market? Is that easy for them to do that? So if the place becomes very crowded, then it may not be profitable for the companies. So this also factor plays a very important part. Then we talk about the government attitude. Is the government trying to promote such kind of industry, or they are not in favor of such kind of industry and they put a lot of regulations and they are hostile towards the industry. So we have to look that also into account. Then we talk about the profitability and cost. Is the industry overall profitable? Are the costs being well managed by the companies within the industry? And they are not affected because of some kind of a constraint with regard to the raw material or other things, or availability of the raw material and other inputs which the industry requires. Then after doing the economic analysis and the industry analysis, then we do the company analysis. Look at the growth prospects of the company. Here we look at the best company in the industry. I mean, the company which is the leader of the pack. And now we look at the growth prospects of the company. So is the company growing? And then we look at the market share. Is it the market leader, or it is having a less market share? Or how is the market share being captured by the company? Is the market share improving, or it's coming down? So we would like to actually invest in the companies where they are trying to see that the market share is improving gradually. Then we look at the track record of the management. How is the management? How well they are managing the company? Are they making good strategies to accomplish their goals? Are they using their resources well? Then we talk about the corporate governance track record. So here, how the company is taking care of all the stakeholders of the company, how they are using their resources, are they fair and transparent? Then we talk about the government attitude towards the company. And finally, the profitability and net worth of the company. What is the future prospects in terms of profitability, in terms of operating margin, in terms of its assets and liabilities, how the company is financed, is the company relying more on debt, or it's a balanced kind of a financing both from debt and equity. So we do all these kinds of analysis while we do a company analysis. Hope you all enjoyed the lecture as much as I did presenting for you. Do add your comments, as it is very encouraging and motivating. Please do like and do subscribe. Thank you.